Hey guys, so I'm going to go through our monthly update for November 2022 again. This consists of two core chart packs, the one from CoreLogic themselves and then the RBA's chart packs as well. Not going to go through every single one of those charts, but I think it's just good to have a bit of a touch on where the current housing market is and some of the indicators the RBAs are watching and just having a look at overall economic understanding of where the market's at. Now, obviously, there's thousands of sub-markets across Australia, so I hate sort of looking at the whole market as it is, but again, it gives us a good consensus of what the general feel is out there. So first page, we're at a $9.5 trillion industry within just residential industry. And when we compare that to super at 3.3 or stocks at 2.7, it is the leading space. But on top of that, we've got the commercial real estate side as well, which is a 1.3. If you put them together, it's a $10.8 trillion industry within, residential housing or property as per se. We have a $2.1 million or $1 trillion outstanding mortgage debt. So again, running at a nearly 20% or just a little bit higher, maybe 25% LVR across the country. 57% of household wealth is held within housing, and we're doing about $5.5 or nearly $500,000, nearly $500,000 sales per annum in the space. So Australian dwelling values, this is overall, and again, this is looking at the market overall, not just individually. Based on the last 3 months, we're down 4.1%. So national home values fell 4.1% in the 3 months to October, which was steady in the 3 months decline to September. Over the last 12 months, we're only down 1% or just under. So dwelling values in Australia are negative 0.9% lower over the past 12 months, making the first annual decline in national home values since October 2019. So back in 2019, essentially, we had the federal election in that year, which there was talks about government policies coming into play, which were going to change their whole negative gearing tax around everything. So everyone was kind of like sitting on their hands during the election period. And the other thing that we had as well was the APRA made some changes in calculating the buffers on getting a mortgage, and so I can't remember the specifics of it. That's why I'm pausing, because I'm trying to recall. It wasn't that long ago, but yeah, APRA essentially changed the calculation on what you could borrow as a bit of a borrowing capacity calculator. So those two things together through the property market in a bit of a slowdown, and so that was what was driven by these two. And then this one's obviously interest rates have increased by, well, they're up to 2.something% at the moment, which is pretty significant. I think there's been a significant increase in the cash flow over the next little while, and it's probably in one of these charts down below, so we'll go through that specifically as is. But what happened during the COVID period, interest rates or the cash rate was at 0.1%, which is almost sort of 0%. And so APRA during that period made the buffer, they increased it from 2.5% to 3%, just so that, people didn't have these ludicrous borrowing capacities, even though the borrowing capacity was still quite high. And now that the cash rate is now at sort of 2.35% or above, again, don't know the specific number, can't remember off the top of my head, but I'm sure it'll be down below. And the borrowing number on top of that is at 3%. We're now getting assessed at these really, really high levels, which is really declining borrowing capacities and making it much harder to get access to finance. And what happens when it's harder to get access to finance is people don't borrow as much, which means they can't spend more on property, and so they go for either lower quality property, and so that sort of middle tier still does regularly okay, and that higher tier generally cops it because people don't have as higher amount of money to spend on the better quality properties, apart from the select few. Then we've got this capital city recap here. So the monthly pace of decline slowed through October. While the housing market downswing has become more broad-based, the monthly rate of decline slowed negative 1.2% from negative 1.4% through September. So 3 month change, we can see a little tick up here, which is pretty interesting to see. Again, combined Australia is negative 4.1, combined regionals is negative 4.1, and then combined capitals is negative 4. Only one in positive at the moment is regional South Australia. Everything else seems to be in decline. And again, you can see, how dramatic these ebbs and flows and swings are coming. That low in the end of 2017 or 2018. And then again, it comes down in that 2019 period. and now we're even significantly below that period as well, off a massive increase. So, falling wise, it's a huge change compared to where we were, sort of at positive 6, 7, 8%. We're down negative 4%. So it's almost a 10% swing from end to end, which is quite dramatic. 12-month change though, the combined rentals are still positive 6.6%, which is really interesting to see. But the whole of Australia is down 0.9%, nearly 1%, and then combined capitals is down 3.1%. So for our capital cities, everything is essentially in decline. Darwin is just at 0%, and then we've got Adelaide at negative 0.6% and Perth at 0.7%, so not too huge from that side of things. But interesting enough, with some of the other capitals, so Sydney, Melbourne, Hobart, and what looks like ACT, we are seeing a bit of a tick up now, which is very interesting. Brisbane is still on that downward swing. It does look like it is slowing though, so that's a bit of an interesting indicator. But we can see those tick ups in the last couple of months, which is really interesting. This is capital cities, 12-month time frame. So interesting to see that little tick up. So capital cities, as we can see, and this is what I was talking to you before about the high range properties that require the most amount of money. When borrowing capacity comes down, they generally lead the way in terms of people can't afford to borrow those higher prices. And so the highest 75th percentile of property is down negative 6.2. Same with Brizzy. Melbourne's down 3.6. Now, interestingly enough, Melbourne didn't have as much of growth compared to Sydney during the pandemic, and so we can see that the decline hasn't been as significant. So we can see here, when we compare Sydney to Melbourne, there's a lot more growth in the Sydney market. Adelaide, Hobart is negative 4.1 across the board, which is cool. Interesting to see. And ACT, again, that higher percentile is leading the way. So interesting to see. Housing cycles, so the rolling 28-day growth rate in CoreLogic Daily Home Value Index. For combined capitals, home value index fell a further 1% through the 28 days ending to October 31st. However, the pace of decline slowed, having hit a recent low of negative 1.6 in early September. So interesting, starting to see that negative growth have a bit of a tick up or level out, which is good to see, but it is still down negative 1%. In Sydney, so in October, Sydney dwelling values declined 1.3%. Over the quarter, dwelling values have decreased by 5.3%. Over the past year, dwelling values decreased by 8.6%. Sydney dwelling values are now negative 10% below their record high, which was in January 2022. So at the start of this year, 11 months ago, that's when we're at the high, and we've decreased 10% since then. Melbourne, we're down 0.8%. Over the quarter, it's 3.1%, and then over the last year, it's 5.6%. Melbourne dwelling values are now negative 6.4% below their record high, which was in February 2022. So Melbourne is now down 6%. Brisbane, again, on that bigger decline now. So October, Brisbane dwellings are down negative 2%. Over the last quarter, it's 5.8%. And then over the last year, it's it's still positive 8.4%, which is really interesting, right? Because we have seen some really significant growth in Brisbane, and it's driven by a lot of things, sort of that COVID lifestyle change. Now people can work from home a whole lot more. They've got better lifestyle, potentially move there and enjoy the lifestyle while still working. We've also got the Olympics in a couple of years there now. So a lot of those factors were bringing a lot of people from Sydney and Melbourne were flowing to Brisbane or Queensland. So we had a big drive from that local population drive. So the market still consistently looks quite strong there just because of those factors. And it is still positive 8.4, even though that dwelling values are now negative 6.2 below their record high, which was in June 2022. So Brisbane market peaked a lot later than both Melbourne and Sydney, and we're still seeing that sort of decline come through now. Adelaide, October was down by 0.3%. Over the quarter, we're down 0.6%, but over the past year, dwellings have increased by 16%. So what's looking like a bit of a peak of the market back in July 2022 We're only now down 0.6% since that peak, which is quite interesting to watch, see what's going to happen over in Adelaide over the next sort of quarter or 6 months. Perth, same sort of story here. So October, dwelling values were down 0.2%, over the quarter at 0.7%, and then over the past year we're still positive 4%. So Perth again saw a massive uptick during that October 20 to 21 period, closer to the 21 period, looking quite strong there, and then we're still positive overall, but Perth dwelling values are now negative 0.7% below the record high, which was in July 2022. Hobart, we are seeing negative over the year, which is interesting. So October Hobart dwellings declined at 1.1%. Over the quarter, we're down 4.1%. And then over the past year, dwelling values have decreased by just the 1%. But the values are now negative 5.7% below the record high, which was in May 2022. Darwin, October, we're down 0.8%. Over the quarter, we're neutral. And then over the past year, dwelling values have increased by 4.9%, but we are now negative 10% from the record high, which was in May 2014. Canberra. So in July, Canberra dwelling values declined 1%. I wonder if that's a misprint. October. I'm sure that was meant to be October. Over the quarter, dwelling values have decreased by 5.3%, and then over the past year, they've increased by 1%. Canberra dwelling values are now negative 5.4% below their record high, which was in June 2022. So it's interesting to see that all markets sort of peaked between January to July in 2022, and all seem to be starting to come down now at that sort of capital levels. Capital level view, not sort of the hundreds or thousands of sub-markets across Australia. So sales and listings. Sales volumes are trending lower as buyer demand slow. CoreLogic estimates that in the 12 months to October, there were 551,981 sales nationally, down negative 9.3% compared to the previous year. Sales estimates over the year to date were negative 13% lower than the same period of 2021. So interesting, the sales volumes are down nearly 10% compared to the previous year. The 5-year average is around that sort of 40k mark, which is the 6 months rolling, which is quite interesting to see. But yeah, national sales volumes are slowing down, which essentially means there's less stock being transacted, and that sort of heat, or that, you know, when you're at an auction and there's multiple parties bidding for the same sort of property, and then they miss out, and then they, as soon as the next one comes up, they want to aggressively buy that, and you have this sort of snowball effect of people missing out on property because there's only going to be one bidder or one owner of a property or one winner of an auction. And when you have 2, 3, 4 people going for the same property and they miss out, that flow-on effect starts to come through for the rest of the properties, and you have this big drive in pricing. But since the sales volumes are down, less people are interested, can be considered a bit of a factor of a slowing down as well. Might just be the consequence of the slowdown itself, but could be also a driver. So the median days on market are starting to come up again. At the national level, properties are taking longer to sell. In the 3 months to October, the median days on market was 36, up from a low of 20 days over the 3 months to November 2021. So 20 days on market is quite crazy. If you think about an auction campaign, usually it's sort of 4 weeks or 30 days, or 27 days or 28 days or something like that. So for most properties to be selling at 20 days, it means they're either selling before auction or they're bringing forward the auction. Now we're at 36 days. And again, if you think of that number of 28 days, it typically means that properties are going through an auction campaign, potentially passing in at auction and then getting sold a week or two after the auction, which is interesting to see. Combined regionals are much higher at 42, where combined capitals are at 33. And yeah, regional Northern Territory is nearly at 60 days, which is the longest. And the shortest seems to be in 2021, it was 8 days in Hobart, which is crazy. But in 2022, yeah, it still looks to be sort of Perth at about 24, which is pretty strong considering an auction campaign. Vendor discounting. So similarly, vendor discounting has also increased from the recent low of negative 2.9% recorded in the 3 months to November last year. In the 3 months to October, the median vendor discounting at national level was negative 4.3%. So starting to provide more discounts the vendors are compared to what it was listed as on the market. Across all, at a national level and across combined regionals and combined capitals, it's still at negative 4.3% throughout. And then the biggest discounts happening over in Sydney at 5%, compared to 2.7% last year. So they're almost doubling the amount of discounting that they're giving. And the lowest looks like it seems to be in regional Northern Territory at negative 3.5%. Very interesting. So listings in the 4 weeks to November 6, new listing volumes trended higher out of 38,000 new advertised properties added for sale. The new listings trend is showing a slight seasonal uplift. However, the new listing volumes remain low relative to previous years. Yeah, so typically we have this sort of spring selling season coming into December, where everyone starts to take some time off and go on holidays, and we pretty much stop selling completely in that period. So there's a bit of a peak now, but we can see even if we go all the way back to 2018, we're still at a very small level compared to where we were, which means there's a lot less listings on the market. Compared to the same time last year, we're down 25%. And based on the 5-year average, we're down 21%. So a lot less listings are on the industry, lack of stock. And that just, again, might be a consequence of the current market and people not wanting to sell because they don't have to. And we're in bad market conditions, so they're reluctant to potentially sell. Could be a big impact. Interesting when we compare, this compared to sort of March, April, May, June, July period, where we're relatively high compared to previous years, and now we're actually at the lowest we've been compared to the last 5 years. At the national level, total listings were fairly steady through October. Advertised stock levels remain low compared to the previous years, as part due to the substitute flow of new listings. Yeah, exactly. So we're starting to, again, come down from that total listings over the 4 weeks ending to November 6, where we've got about 150 listings on the market. Total advertised stock levels are once again relatively low across Australia. Though stock is rising in some of the smaller capital cities during the upswing, stock levels were low as a result of strong absorption from sales. As housing values decline, advertised stock levels are reduced due to the lower vendor activity. So Australia again is down negative 25%, combined regionals negative 22%, and combined capitals 27%. Total listings change from equivalent period last year is down 6%, and then regionals is 4.4%, and combined capitals is 6.8%. So capitals are really having a lot less stock on market, and again, really struggling with new listings coming on as well. Weekly clearance rates. So the combined capital cities clearance rate steadily through October, steadied through October, averaging 59.5% in the 4 weeks ending November 6. This is down from the 78.5% in the equivalent period of 2021. So looking like, we did have a bit of a drop with the clearance rate sort of 4 or 5 months ago. It has bounced back up, but now is starting to drop down again a little bit as well. Volumes are quite low as well compared to sort of where we've been previously, which is really interesting. But yeah, that clearance rate is still indicating that it is a buyer's market rather than a seller's market. Once you've got a clearance rate that's sort of above 68-70%, that'd be considered a stronger seller's market. Rental market. So rental value growth remains high across Australian dwellings, but the annual growth in house rents has shown signs of moderating. Unit rent values have seen increased momentum, rising 12.4% in the past 12 months. Across all the dwellings, this resulted in an annual rent growth rate of 10%, which is quite crazy when you start to think about it. Rents increasing by 10% across the board. Now you do have that effect of values coming down and rents increasing. So we go through this period of COVID where we had rental shortages and rent pauses and all these sort of seasons. So you can start to see that flow-on effect come through now. It's having a bigger trigger later on down the line as we go, we revert back to the mean and we have that elasticity in the values of rents. And this is really shown in sort of the yields as well. So through October, Australian gross rental yields rose 3.7%, up from the recent low of 3.21% in January this year. Since the end of 2021, gross rent yields in Sydney have lifted 59 basis points and 40 basis points in Melbourne. So Australia, the average yield is 3.7%, combined regional is 4.4%, and combined capitals is 3.4%. Biggest driver is regional Northern Territory at 7.1%, and the lowest is over in Sydney at 3%, and not followed quite closely by Melbourne at 3.1%. So gross yields across the board are about 3.7%. Dwelling approvals and housing credit. So dwelling approvals declined 5.8% in October, led by a 7.5% drop in the new house approvals. Unit approvals also declined by a similar 3.1% over the past 6 months. Unit approvals averaged 6,000 per month, which is below the decade average of 7,400. So pretty interesting to see. Units have declined. Houses have declined off the big kick up in the last little while. All right, now for finance and lending. So housing finance secured total $25.1 billion in September. The value of secured housing finance fell negative 8.2% in the month, taking new housing finance 22.4% lower than the recent peak in May. Investor finance fell 6% compared with the negative 9.3% fall in owner-occupier lending in September. So a lot less owner-occupiers purchasing. Well, the fall has been greater on owner-occupiers compared to investors, but we can still see a pretty significant tick down. Interesting enough, monthly value of new finance in the millions for owner-occupiers at its peak was at like 22 million. Finance total in millions. Interesting. I wonder if I can't read that. Is it 22 billion? Anyway, it's at 22 something, and investors are at looks like 8 or maybe 9 or 10. They're at their peak, and then that's obviously both significantly come down at 6% for investors and 9% for owner-occupiers, a bigger fall in the owner-occupier space. Portion of new lending for investment housing, excluding a refinance, is at about 33%. So historically, it's been a high at 34%, and now it's at 33%. Investors and lending. So nationally, investor finance comprised of 33.1% of new mortgage lending through the month of September. This is below the decade average of 34%. September marked the first month since May, which owner-occupier lending declined faster than investment lending. Interesting. So owner-occupier lending is coming down quicker. So then we've got the different states broken up here. Biggest investor space is Queensland, still New South Wales at 36%. Followed by Queensland and then Victoria. And then the smallest investing state is Tas at 24%, with WA at 27% underneath that. First home buyers. So first home buyers by finance fell at negative 6.8% through September. This was smaller than the rate of decline in owner-occupier finance overall, pushing the portion of first home buyer finance higher. First home buyer finance rose to 24.1% of new owner-occupier lending through the month. First home buyer as a percentage of owner-occupier finance commitments by state, and then first home buyer as a percentage of owner-occupier finance commitments. Yeah, very interesting. So first home buyers are averaging about 24%, and this has come down again pretty significantly from that 2019 peak across the board, or in Victoria, which is the highest, or maybe WA, which is the highest, was at 35-40%, and now it's come down to sort of 30% there, 25-30%. And this is what I was looking for. So the cash rate's at 2.85%. So the RBA lifted rates to 2.85% in November. So the board has increased the underlying cash rate by a further 25 basis points. So we're going back to back on 25 basis point increases now, where previously we were increasing at a rate of 0.5%, 50 basis points. Inflation in Australia remains too high, with global factors and strong domestic demand sustaining inflationary pressures. Inflation is expected to peak at around 8% this year before declining in 2023 due to the ongoing resolution of supply side pressures, slowing growth in demand and easing commodity values. The labour force is still very tight. However, employment growth is starting to slow in the recent months. The board reiterated further increases in cash rates ahead as it remains resolute in returning inflation to the target range. So the target range of inflation is between 2 to 3%, and they're expecting it to peak at about 8% this year. So they're not too concerned about continuing to increase the cash rate, although it is at a lower rate than they have been increasing previously. At that 2.85% level, though, we are now higher than we have been for almost 10 years. So back in November 12, we were around about the same sort of level. So the highest cash rate we've been in for the last 10 years, which is quite significant, and it is a big move. And it is really trying to get that inflation down packed. What that does means that people have to spend more towards their mortgage, which means they've got less surplus cash flow that they can then go and buy big expenses or put back into the economy, which drives the prices of things higher, the prices of goods and services higher than they have been. And by turning that down, it does slow the economy. It means jobs start to get lost and all those sorts of things. And so that's why they reinforce this statement about the labour market still being very tight. So when they start to see employment come down and people getting unemployed and that employment rate being higher, that's when it's starting to have a big impact, that less and less spending. So they want to have that cash rate between that 2 to 3%. And they'll be also watching those charts as well. Housing credit. So through September, average new fixed rates remained elevated on variable rates. However, the average long-term fixed rate for new owner-occupier loans declined for the first time since November 2020. So it has come down just slightly, which is really interesting. So variable is at about 4.38. Fixed rates less than or equal to 3 years is at 4.7. And then fixed rate greater than 3 years is at 5%. So it's starting to tick down, which is really interesting to see. Markets obviously starting to factor in, or the banks are starting to think, all right, maybe we can start to bring down that fixed rate. But for investors, we are still ticking higher. So variable for investors is at 4.76. Fixed rate less than or equal to 3 years is 5.0%. And then fixed rate greater than 3 years is now at 5.7%. Which is really interesting to see. So mortgage originations for riskier types of lending trend lower through the June quarter of 2022. APRA data shows that the amount of potentially risky mortgage lending has generally trended lower through the June quarter of 2020, with exceptions of the portion of lending of interest-only terms. So percentage of loan terms on interest-only is still high at 19.8%. The lowest it's been in this little chart here is at 17.5%. So fluctuates between sort of 17.5 to 20% there, which is really interesting because a lot of people that I talk to are on interest only. Obviously, this chart shows a different story, so just interesting to see what the proportion is of interest only loans. Percentage of loans originated with a loan of income ratio of 6 times income, so most people can borrow about 6 times their income. It seems to be about steady at that 10% level. It was much lower in sort of 2019 when APRA had those changes come into play, and then we slowly increased, started to tick up in December 20, and now we're at that sort of 10% range and have been around there since March 2021. Percentage of loans originated with a debt to income ratio greater than 6%. Percentage of loans originated with a loan to income with a debt to income ratio. Yeah, okay. So people have got about 22.1% of debt compared to their income, which is really interesting. And again, that's trended much higher in the same sort of period. So roughly September, December, we started to increase that number from sort of 16%, lows of about 14.5 or 14.6% there, and now we're at 22.1. And then the last chart, we've got the percentage of loans originated with an LVR greater than 90%. So this is people using a 10% deposit, has come down significantly. So in March 2021, we peaked at about 14.1%, and now this has come down quite significantly, whether that be banks tightening that type of lending completely, or investors being a little bit more cautious around what is going to happen and want to lower LVR moving forward into the future. So always great for the core logic chart as usual, just good indicator to see where the market's at. Big takeaway from me from today's report, and again, I always read these things with you guys rather than like by myself, but this 28 rolling day index is starting to come up or neutralize a little bit, which I thought was very interesting. And then these little tick ups in the Sydney, Melbourne and Hobart and ACT numbers is quite interesting. People are talking about a bit of a camelback scenario here where we have a little bit of a tick up and then things start to look bad again and then they should come back up. So it might be a bit of a false positive, but it is good signs. It means that these markets are ticking up a little bit. But yeah, just looking over to our friends in America and our neighbours over in New Zealand, things aren't looking quite good. The cash rate in both those countries are quite high and inflation numbers are quite high as well. Obviously Australia is a completely different economy and is relying on different things. But we are definitely in a sort of similar category. Good to know that some of the pain has been dealt with and we're not, sort of in this free fall with markets dropping, depending on how long the sustained rate of growth stays. But just looking at these charts here, there's a bit of a tick up come through, which I think is very interesting. All right, now onto the RBA chart pack and just sort of breaking down some of the numbers on a greater global level. So our GDP growth in the world has, bounced back significantly from that COVID period where everything was essentially shut down. We had a big jump up, which was coming out of trading period. So when you have a slowdown and then people trying to catch back up again, we're now sort of sitting at that, just under that 5% level where, we have been for the last couple of years, bar, some periods of some slowdown, economic crises and stuff back in 2018. So that's good and great to see. Let's go down to the Australian numbers now. GDP growth in Australia. Yep. So again, same sort of story here. We had a slowdown, then a tick up, and now we're just under 4%, which is great to see. Contributions to GDP, the biggest one has been consumption. And again, that's where inflation starts to really come into play when we're consuming and spending on consuming. That does have inflationary pressures compared to, exports or government spending or, all these other things that do have some sort of an impact as well, but consuming is definitely one of those biggest ones. How's come in? So CPI, so inflation is still on that very high trajectory. You can see that these numbers though are quite reactionary, so they do bounce up and down quite aggressively. Inflation at the moment is at sort of 7.3%, which is very high compared to, in recorded history, we've actually never been this high. We go back past what looks like, 1995, 1992, something like that. So very high inflation in Australia at the moment, and that's why we're doing unprecedented things to hopefully get unprecedented results and address these unprecedented economy impactors. Household income and consumption. So the savings ratio has come down completely during the pandemic when we essentially couldn't spend. We're saving nearly 20% of our income. We're now at about 9 to 10%. Which is interesting to see. And then consumption and disposable income, again, we're consuming around 6 to 7% there, and then our disposable income is just sort of 2-3% there, which is also interesting. Consumer sentiment, so this is something that I've been watching over the last little while. We did have that bit of a tick up, which looked like some green shoots, but unfortunately now it has come back down and ticked down. We're at that lowest level that we have been in this recorded history period as well, which is quite interesting to watch. But yeah, interesting to see what's going to happen there. Dwelling investment, we're at about 26, 27 bill. Private residential approvals, again, we saw this in the core logic chart, so I'm not going to go over it too crazily. Housing prices, So housing price and household debt. So the ratio to household disposable income was quite high. Now we've come down to just under 6%. And then household debt is at sort of that 1.8 mark, just below 2, which, you know, is quite crazy when you think about that disposable income compared to the debt, and sort of shows you why these interest rate movements have such a big impact, especially on household budgets. So household wealth and liabilities, net wealth were up pretty significantly. The majority of that is in dwellings, at about 700, 650%, and then financial assets is at like sort of 450. Housing prices, again, this is all the different index. So we did see the Core Logic index, which is pretty much the only one with recent data. If we have a look at sort of APM, Residex and ABS, they are all quite behind. So Core Logic with the driving numbers there. Loan commitments we've already seen as well. So the NAV business survey is an interesting one. So business conditions are still looking quite positive. Business confidence is quite neutral compared to, historically we're not sort of negative or positive. We're just sitting there. And then capacity utilization, we're up nearly sort of 90% there, which is quite crazy. Yeah, so economy is still looking okay. The other number, so we've got the wage price index growth. Wage price indexes are increasing, and they should do with inflation, but you don't want to create this inflation spiral where you increase wages too quickly, which means people have more money that they can spend and put that in the economy, which increases inflation and then in turn increases wages, and so you have this spiral upwards. So you do want some help or some wage increases to counter inflation, but not too much. So that's why it's quite a hard balance. And then we've got the labour utilisation rates as well. So the unemployment rate is sitting at about 6%, which again, is quite low considering the last time we were there was sort of 2008. And then, this is the underemployment rate. So this is people who want more work, are working but want more work. But the biggest one is the unemployment rate, which is just above 3%, which again, I don't think we've been this low in recorded history, which looks like it's about 20 years. So this is even though there's a bit of a tick up there, this is definitely one of the charts the RBA is watching, just to sort of see how much of an impact these interest rate movements are going to have on the employment market. So yeah, bit of a snapshot there of the Australian economy. These chart packs are all online and for free, so you guys can get access to them at any point in time. Feel free to go through all these charts and graphs yourself, but I think I've just highlighted the important ones, considering this is property specific. So yeah, let me know your thoughts. Let me know if you want me to continue to do these, if you've got any feedback or anything else like that, and I'll speak to you in the next video.